Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here's your daily technical analysis of stock index futures. I'll start with the UK FTSE futures. An even bigger second long black Mariposa and fourth bearish black crow on Friday. It was a continuing more than suitable follow-on lower to the recent very interesting combined key reversal down and bearish engulfing pattern right at the top of the market. This time, the market fell down through and closed below the following. The medium moving average, currently 74.25. That really was the thing that really pushed it down. But it was also testing the upper trend line of what I had labeled a possible descending, expanding wedge pattern, currently 73.84 to 67.63. Finally, closing below that, and then also finally closing the flatlining long moving average, currently 73.16. This was a momentous decision, closing back well within the possible descending, expanding wedge pattern, as well as the long moving average. Now, as you should know by now, I haven't been entirely happy with this possible descending, expanding wedge pattern. Hence, there is a heavy dose of the word possible in front of it, especially now. For starters, it hasn't completed the requisite 5 touches combined of both trend lines, yet leaving that aside for a moment. Let's leave that aside for the moment. As well as its short life and steep downward angle, leaving all those things aside, we still do have this pattern. This led to now three diametrically opposed questions. 1, is it a false break higher? 2, how high will the move be? And 3, is there some other pattern being constructed that may usurp the superiority of this pattern? Okay, so for question 1, well, if it was a false break, then we should have known by now. Well, you could argue the case we should. Last Wednesday, I thought the answer was a definite no, but after Friday, things look a lot different. For question 2, well, a primary target X would be in the 78.67 area. For secondary, a much harder to reach target X1 in the 79.46 area. These are big asks of this market, especially from what in truth are not too good looking descending, expanding wedge pattern. And with what has happened last week, finally, 3. Is there another pattern? Well, possibly was my answer last week, and I expanded on that with the following, and I quote, I have an idea but I'm not happy about sharing it just yet, as I would like to see some more action, end of quote. So, we've undoubtedly had more action, and there is a big pattern that might be in the offing. It is an early March to date, large ascending triangle pattern. The flattish top side is based on the recent high at 76.45, with the early March to date uptrend, currently 73.03, making up the lower trend line. This trend line is currently just below the long moving average. That's currently at 73.16. And it was pierced, but not closed below on Friday. Now, one final item to mention this last Thursday and Friday. We have a weekly key reversal down last week. I'll just let that sit with you for a while. A weekly key reversal down last week. So far today, we've had a small gapping lower open below the lower trend line. That makes up the trend line for a possible very large ascending triangle pattern. If we close below this trend line, then we will retire targets, the X targets above, and start working on a possible target for the market below. German DAX futures. A bearish long black Mariposa and a fourth bearish black crow on Friday, with a continuing more than suitable follow-on low to the recent significant key reversal down. What was interesting about Friday's action was how it basically slammed through and closed below the significant wide congestion band, 14.079 to 13.804. Now within this band we have the February 2020 high at 13.821, and the 50% Fibonacci line of the October 20 to November 21 move at 13.804. Most importantly, the market also closed back within the proposed April to May descending expanding wedge pattern. And that's currently 13.791 to 12.496. This places the upside targets for this pattern, which I may well retire this week. There is a primary target X in the 15.440 area, and a secondary and harder to get target X1 in the 15.725 area. These are big asks, and finally to cap it off, we had a weekly key reversal down last week. Now, so far today, a significant gapping lower opening and a further significant move lower. In a fairly free territory, though, some congestions in the 636 area, and towards the next support below, the February 21 low at 13,356. Below this, we have the 2021 low at 13,300 and the April low from last week at 13,272. When you say the April low, just the low from last week at 13,272. US E-mini S&P futures. A significant bearish open and close long black Mariposa on Friday. That was also a third bearish black crow and another more than suitable follow-on lower to the recent bearish double pattern. Prices opened a little higher, but then punched down and closed below all of the following. The 50% Fibonacci line of the October 20 to January 22 move at 40.18. Congestion at 39.89, the February 2021 high at 39.59, plus congestion at 39.11 and 39.02. So, okay, all this started with a scenario I've repeatedly described. You see, looking back a bit, with the markets rejecting the overhead resistances of the upper time, currently at 41.36, of the January to March bearish Andrews Pitchfork, as well as the middle time, currently 41.64 of the bearish shift pitchfork for the same period early last week. Thus Friday and even now is the outcome of a danger period of something I've spoken about for weeks. This is the crossover period of the two tines of the previously mentioned January to March Andrews and shift pitchforks. I'd earlier highlighted the previous crossover of tines from these two pitchforks on Thursday 4 weeks ago as a period where one could expect one or more of the following: volatility, a change in trend, or a reinforcement of a trend. This was an important time period, and I highlighted it with a red circle on my daily chart, which you can also see, and also drawn another red circle for the next crossover to come for these same pitchforks. This is of the upper tine of the bearish Andrews and the middle tine of the bearish shift pitchfork, and it was centered on the 7th of June. Hence, I renewed my warning at that time and what to look for. Look for volatility, a change in trend, or a reinforcement of a trend. It seems we have had the change in trend situation with some volatility also thrown in. That is what happened these past few days, and maybe today, maybe, for your information, the next crossover, indeed the last crossover of these two patterns, will be on the 12th of August, assuming the pitchforks are still intact by then. Now, so far today, another significant move, a gapping lower move that dropped down below the lower tine, currently at 38.65 of the bearish shift pitchfork, as well as below the congestion at 38.44 and the lesser Fibonacci lines at 38.32 and 38.02, as well as the main low at 38.07. Prices have finally halted just under the lesser Fibonacci line at 38.02. We now have the middle tine of the more acute, bearish acute, Andrews pitchfork, currently at 37.61, plus the February and March lows for 2021, respectively 37.20 and 36.56. These actions now threaten the proposed time crossover of the 12th of August. Thank you for listening. This short version broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.